Welcome back to the Sunday Business Page.
If there's been one phrase that we've heard throughout the year to describe the performance of the stock market in 2007, it's been a roller coaster ride. So as we finally near the end of that ride, what's ahead for 2008? And for investors whose stomachs are still queasy from that ride that never seemed to end, what kinds of strategies should we all be examining for 2008 that can give us economic growth yet peace of mind? P.J. DiNuzzo is a certified public accountant and president, founder, and chief investment officer for DiNuzzo Investment Advisors in Beaver. He joins us this morning on the Sunday Business Page for some financial tips for the end of the year. P.J., welcome back.
Good morning, John.
You know, as we approach the end of the year, are there some things we should be doing that would be very helpful to us to position us for 2008?
Yes, probably the most important would be not to overreact to the roller coasters, as you previously mentioned. Individuals need to take a real good look at their portfolio and make sure that they're well balanced between a good allocation from stocks to bonds in their portfolio.
You say not overreact. Do you mean just stay the course?
Yeah,
Keep our investments where they are?
Well, to stay the course, a lot of folks tend to overreact, and for example, the word recession has been bandied about this year and potentially maybe into next year at the beginning of the year. But individuals don't want to overreact to that. Really, recession is just part of spring, summer, winter, and fall. Through portfolio growth, our economy grows, it plateaus, it descends, it levels off, and it grows again. So they just don't want to overreact.
Is it a function of where you are in your life cycle in terms of what you ought to do at the year end? For example, if you're someone in your 30s and 40s, maybe you just don't do a thing. But if you're nearing retirement, let's say you're planning to retire next year or the year after, does that make a difference?
Yes, it would make a difference. The largest error individuals make is not being properly allocated in their portfolio. And as you stated, individuals in their 20s, 30s, maybe into their 40s could be 100% in stock, maybe 70, 80, up to 100%. Whereas nearing retirement, you need to you need to develop a different strategy that's more well suited.
And is it ever too late to make that change?
Well, it's too late from a tax perspective after December 31st. There's some things that you really want to take a look at before the end of the year, rather walking into your CPA, your tax preparer in February, March, or April and saying, okay, what can I do to save taxes last year? I mean, the toothpaste is already out of the tube.
Yeah, well, let's talk about that because we're not yet at the end of the year. What is it that we ought to be talking to our tax advisors or CPAs or just doing ourselves that would put us in a better tax position before we hit January 1st?
Yeah, John, what every individual wants to know is their unrealized gains and losses that they have in the portfolio. A lot of individuals still have tens of thousands, if not maybe even six figures of unrealized losses that they haven't used up from 2000, 2001, and 2002. Those are very valuable, and they want to take a good look at harvesting those losses to offset some gains in their portfolio to save on their taxes.
Well, now, these aren't losses that would be in your 401k. You're talking about the other,
yes,
if you have other accounts, taxable accounts. And you're saying that people actually have losses in their accounts that they've not taken advantage of?
Yeah, you're allowed to, the IRS will allow you to carry over loss carry forwards, and you can only utilize 3,000 of those per year to write off net if you don't have any gains. But a lot of individuals have gains in a portfolio, so they can sell something to be able to use up maybe $5,000 or $10,000 or $20,000 of those losses and not pay any tax on that capital gain.
Bottom line, this sounds pretty complicated for just us average folks. I take it you need a CPA or some kind of tax advisor to guide you through this process.
Yeah, a qualified tax advisor, and we recommend by the fourth quarter of the year to sit down with your tax advisor before the end of the year, take a look at these issues because they could put dollars in your pocket.
Are there other sorts of things that you can do from a tax standpoint that you think would be worth taking a look at?
A tax standpoint, a lot of individuals would want to take a look at. Sometimes people get upset where they buy a mutual fund right before it makes the distribution. Take a look at the ex-dividend date. If you're very sensitive to that, you don't want to buy it right before that and, so to speak, buy the dividend and have that reported to you on a 1099 so that you're having to pay tax. You may want to take a look to go online and take a look if you're thinking about buying a fund. Maybe wait until after the declaration date, after the ex-dividend date, and buy it so you don't pick up the capital gain distribution for this year.
But most folks, I think, realistically, most middle-class folks, they have their 401ks, and that's pretty much it, isn't it?
Yeah, that's by and large the bulk of their assets for retirement.
And there's not much you can do at this stage, or should you? I mean, you can reallocate within your 401k at any time. Would that be a smart strategy, or would you say just stay the course?
Well, to reallocate, but what a lot of individuals do is they tend to chase the hot dot, the high performance, and a lot of individuals have too much money right now in small cap stocks, international small cap, and they really want to take a good hard look at reducing those exposures to get back into line with having more in U.S. large caps than they would in U.S. small caps to get back to a more traditional allocation.
So you're suggesting that it's best to invest in those big U.S. operations here?
Yeah, a lot of folks have forgot about them. They've been off the table since from what occurred in 2001.
Oh, yeah, the big call was get into international. You're saying get out of international?
Well, reduce the exposure. We're seeing a lot of individuals who come to us and have the supermajority of their portfolio in U.S. small cap stocks and international stocks, which is just turned upside down. It shouldn't be that way.
Yeah, interesting. Hey, we only have a minute or so left. Let me ask you about 2008. I'm asking everybody this. Yeah. What's your prediction for 2008?
2008, we would expect that the market is going to come back and we're going to have a reasonable rate of return. We'd expect something in a 7, 8, 9% for the broad market. If you looked at from the S&P 500 to the Wilshire 5000, the broad U.S. market, that we are going to have a positive year and we'll be up modestly in that range.
What makes you optimistic?
The equity premium, capitalism's alive and well. We know what the market's done for the last 25, 50, 75, 100 years. It's working. It's going to continue to work.
It's also a presidential election year. Does that make a difference in terms of our economic growth?
Yeah, that can tend to make a difference. We don't read the tea leaves on that between all the numbers and going back. You can sort of data mine and come up with a lot of interesting things that seem like they're correlated. But yeah, we do feel very strongly we're going to have a positive year in the market next year. Modestly positive year.
Modestly positive year. Better than 2007.
Yes, yes.
Well, we can all hope for that. We appreciate you coming on the show, PJ. Thank you so much, and we'll have you back again.
Thanks for having me.
Thank you, sir.